This is InvestTalk. Independent thinking, shared success.
Hi, this is Dan from Walnut Creek. I had a question regarding SandRidge Energy, stock for symbol SD. I'd like to get your thoughts on that one, please. Thanks very much. Bye.
So SandRidge Energy, ticker SD, is a $336 million market cap energy company. It's an independent oil and natural gas company. And so they acquire, develop, and produce both oil, natural gas, and NGLs in the United States, I would say primarily. Now, in terms of their business, about 68% of it comes from oil, 36% of it comes from natural gas liquids, and then about 21% of it comes from natural gas. Year to date, they're down about 15.37% over the past 3 months, down 18.9%, down 33.62% over the past year. And so what's really driven them to outperform their industry by about 3.1% over the past year is the difference between how gas is performing relative to how oil is performing. We all know, and we've talked about it over the past couple of days, and we'll talk about it again today, though it is up at the end of the day today. Oil has been on a downward trend for quite some time, where natural gas, which had high demand from all of these data centers, high demand from the AI secular growth theme, really has been doing particularly well with respect to the rest of the energy sector. Now, as a company, they have they actually have no debt. They had debt back in 2020, about $20 million in debt. They have no debt on their balance sheet right now. You see it right here. Long-term debt is at zero. Their sales, though, not headed in the right direction. Is all of that related to the price of oil? Maybe, but either way, revenue's not looking great. Margins kind of all over the place, but very, very high. 50% was their margin last year, headed down to 36% this year. Cash flow headed in the wrong direction, I would say. And one thing that strikes me is they've been issuing a decent amount of shares. And so looking at this company is heavily exposed to the oil industry. We know what is likely, or rather what could happen with oil demand. You've seen it. You saw pop today. You saw pop all across the market. SandRidge is a decent name with no debt on its balance sheet that, again, has been outperforming its industry for the exact reason of that commodity diversity. But given what may happen with global oil demand as the economy starts to slow, not exactly sure now is a good time to buy into a company that is still pretty heavily exposed to oil. 70% of its revenue. 54% of its revenue. Thanks for the call. Let's try and keep things moving. Get a fresh question from the comment section of our InvestTalk YouTube channel. This one on ticker MOH. It says, hey, I'm wondering what your thoughts are on ticker MOH, which is Molina Healthcare, and MDT, which is Medtronic. I had them on my watch list for a while, and they seem to be doing well despite the volatility in the market. I'm a long-term investor, so is this the right way of thinking, or should I wait to buy after the recession takes place? Well, here's the thing. Until the recession takes place is a very unknown quantity. Most of the market was thinking there was going to be a recession in 2023, and then most of the market thought there was going to be a recession in 2024. And now a lot of people think there's going to be a recession in 2025. Now, we've been talking some time, even before this debacle, about how cracks are starting to form in the economy. Does it guarantee a recession? No, of course not. And so if you are a long-term oriented investor, is waiting until the recession that may not manifest itself wise? No, of course not. Now let's take a look. Molina Healthcare, it's a managed care company. It pledges health insurance services to individuals and families through their government programs such as Medicaid and Medicare. Year to date, it's up 16.85%, up 13.75% in the past 3 months. It has outperformed the S&P 500 this year by 24.1%. And it's trading at a relatively decent multiple, 13.1 times forward-looking earnings. And a lot of this is because of their financial performance. Their adjusted earnings in last quarter, stellar. Though missing analyst expectations of 5.77, but revenue, a big winner for the quarter. Now, it's got quite a bit of debt, $3.2 billion in debt on an $18 billion market cap company. But in terms of leverage, it doesn't look too scary to me. Some short interest out there, no dividend yield. Cash flow, though, headed in the wrong direction. Something to certainly note there, as well as the fact that they're actually raising a decent amount of debt from $2.4 billion in 2023 to $3.2 billion last year, but at the same time buying back shares, which is positive. Now, from a relative performance basis, it's been outperforming or relatively strong compared to the S&P 500 since about 2020. But Medicaid does make up 79% of its revenue, and 14% of its revenue comes from Medicare. And so with potential changes on the horizon, how does Molina Healthcare stand to benefit? Right? The expiration of pandemic-era policies led to cost increases. That's why you started to see bottom line profits start to slide a little bit. And so that's also why it's down in the past 52 weeks. It also didn't see as strong a rally today as a lot of the other parts of the market did. And so because of that, given the uncertainty specifically tied to the Medicare and Medicaid space, there is definitely some inherent downside risk to holding this name right here. It looks a little frothy to me, or right here. I think it's a good company, but still the policy uncertainty, which we should get some clarity on potentially soon with the budget deal on the horizon, maybe on the horizon. Certainly some discussions around it. But for now, I would wait to get into Molina Healthcare. That is ticker MOH. Let's get back to the InvestTalk voice bank for a question that came in earlier at 888-99-CHART.
Hi, Justin and Luke. This is Kevin calling from Southern California. Thanks for always having a great show and helping us to navigate these very volatile times. I'm wondering about Roth conversions and deciding whether or not it makes sense to do. I'm already in the highest tax bracket now. Under what conditions would it make sense to do conversion if I'm expecting to be in a lower tax bracket when I get to retirement age? Just looking for your insights. Thanks again, as always.
So that's a good question. So for those of you who don't know, right, you have traditional IRAs, you have Roth IRAs. Roth IRAs, you're putting in after-tax dollars, so they grow tax-free. Traditional IRAs, you're deferring, you're creating a deferred tax liability over time, and you're putting in pre-tax dollars. So you're not charged taxes on it today because you're putting it in before you pay taxes. You do pay taxes on it later when you withdraw. Now, there's other differences as well. Traditional IRAs have RMDs. Roth IRAs do not have RMDs. Roth IRAs have income limits. So if you make a certain amount of money, you can't even contribute to a Roth. That leads to things called backdoor Roths. But eventually, at some point, it makes sense to pay this Roth or to do this Roth conversion. Now, when you do a Roth conversion, what you're doing is you are moving money from your traditional IRA into your Roth IRA. And at that time, there is a tax hit that happens, right? And so you have to recognize it as income and you have to pay taxes on it. And so the number one consideration should always be, is this tax efficient for me? For somebody like him, who is in the highest tax bracket, it almost never makes sense to convert now because you are expecting down the road for your tax bracket to be lower. And so you want to start that conversion and continue to have that money grow tax-free when you may have to pay no taxes or pay lower taxes. And so is there any time at which it makes sense for you to do a Roth conversion when you have a high tax bracket? Because it's not always a perfect rule. And so maybe if you were going to move to a state that had a higher tax burden, right? Maybe you're in a high tax bracket and you're thinking and you live in Florida where you're not paying income tax, or Texas. And you're going to move to a state that has state taxes. And so your effective tax rate, state plus federal, becomes higher. Well, then maybe then you would want to convert. If you are still working, but you're nearing that RMD age and you don't want to pay RMDs, well, then maybe you'd want to convert then. But I think generally speaking, what you're trying to do is use the tax benefits, which only happen when you are in the lowest tax bracket you can possibly be in at your stage of life. And so generally speaking, no, you would not want to convert when you're paying the most taxes. Thanks for the call. Stay informed and stay empowered by visiting investtalk.com today.
Hey, gentlemen. This is Brett from California. I had a question on Realty Income Corporation. I have a small position, just wanted to get your insight on what you think about this company for income and growth in my IRA account. Thank you very much.
So taking a look at ticker O, which is Realty Income Corporation. It is a REIT. It's looking to generate dependable monthly cash dividends on a consistent and predictable level. And it's done that for quite some time. Its dividend yield has floated at pretty much at or above 4% since 2019. It was at 3.8% one year, 3.9% another. Now it's at about 6%. And so the reason why REITs have been underperforming, well, really the entirety of the market was underperforming until today. Right, you had, or rather, the entirety of the market was for the most part negative till today. You had gold down, the past couple of days. You had REITs down. You had equities down. You had bond yields surging. There was really nowhere to hide. Now today, this name is positive, as most of the market was, up 3.27%. Year to date, it's actually outperformed its industry by 11.6%. It's positive on the year, up 1.1%. Now, they did announce their 600, get this is dependable. This is what I mean by dependable. On April 9th, they announced their 658th consecutive monthly dividend to stockholders. And so if you're looking to get a dependable dividend, this is one of the companies in which you can do it. Its price to funds from operation looks pretty reasonable relative to its averages, which really trade in a very tight window. And so it's actually maybe a little cheaper than it has been. And so again, if your goal is to invest in a REIT that's giving you dependable dividends, this is a good one to do it. One thing I will point out is yields are still ticking higher. Even with the market pumping today, yields are still ticking higher. What does that mean? Does it mean foreign governments are offloading US treasuries? Maybe. Does it mean inflation expectations are getting a little higher because of input costs going up? Probably. And so if yields on bonds continue to climb, well, then people are going to be, like they did during the inflationary days of 2022, more likely to shift and allocate and get that income they seek from bonds rather than REITs. That could drive REIT prices down. So that's something to consider. But if you're looking for a REIT and you need that dependable dividends, Realty Income Corporation is a good way to do it. So as we all know, at some point today, I don't know the exact time, the president paused most reciprocal tariffs just about 12 hours after their implementation, citing ongoing global negotiations. And that decision triggered one of the largest up days in the S&P 500 and the NASDAQ ever. Now, obviously, we all like positive markets. If I showed you a list of the top 10 green days for the S&P 500, they're not necessarily around good events, right? Volatility tends to be, as I've been saying, not great for markets. Things start to break on both sides of the frame, up and down. And so what caused this? Well, at first, the Treasury Secretary came out and said, well, this was always the plan, which definitely was not always the plan. One of my favorite quotes from Mike Tyson is, everybody has a plan until you get punched in the mouth. And the thing that does the punching is exactly what we talked about yesterday, the bond market. It does not bode well for the financial system when equities are falling and bond yields are rising. Treasuries are supposed to be the safe haven assets. A lot of things get disjointed when yields rise that quickly, that sharply, especially as everything else is falling as well. And so with this pause, which it's not exactly yet clear to me on who the pause is, because the announcement was if you did not retaliate, you get a pause. Europe did retaliate earlier today. I don't know if the pause is on them. I haven't had time to look yet. But assuming it is, then the standing tariff would be, the one that is implemented now, would be the 125% hike on Chinese goods, as well as 90 days from now, the 10% tariff baseline down the road. Oh, I'm sorry, the 10% baseline is in place as well. Today, the higher rate would be delayed 90 days. And so despite this pause, the average US tariffs has actually jumped from 3% to 20%, a 100-year high. And so it's important to note that this 90-day pause is also not a rollback, right? It's a delay. The can gets kicked a little bit down the road. And so as you're listening to this, as you're watching this, I want to put your mind in the mind of a CEO of a company. And you have to build a factory, and you don't know where to build it. If you know that 90 days down the road, we're going to be back towards this, what do? Now, the answer that you probably came to is you wait. And herein lies some of the risk of uncertainty. If you don't know what to do, you don't spend capital. If you don't spend capital, you don't hire people. Maybe even you lay off people. And so this is why this uncertainty can still be bad in the market, even if things are being rolled back. And so in the next couple days, it'll be interesting to see how the market moves, because the reality is tariffs are still higher, input costs are still higher today than they were a week ago, right? We're certainly better off with this pause now than we were yesterday. But economically, we're still in a more precarious position that is, than we were a week ago. And so as volatility will likely continue to be ahead, as hopefully we see more stability within the bond market, within the equity market, the only thing that will cause the trouble that we've seen is certain laid out policy showing the market where to go, helping managers make decisions. Let's head back to the InvestTalk YouTube comment section and talk a little bit about this question from Carter Erickson, and it's on ticker FLEX. It says, what are your thoughts on Flex stock? Flex is a global manufacturing services company. They provide technology, innovation, and supply chain and manufacturing solutions in a bunch of places: automotive, healthcare, and consumer devices. Now, year to date, they're down 23%. Year to date, they're down 17%, down 23% over the past 3 months. On the 52-week, they're up about 9.5%. Today, they're up 13.6%. Let's look at their growth. Pretty flat over the past 5 years. Looks like the pandemic didn't even really hit them that hard in terms of revenue. Coming out of it into 2022 and 2023, you did see a little bit of explosion in revenue, but that's tapered back. They're reaching back towards March of 2022 levels at this point. Net income has actually grown a pretty significant amount, though, in that time, which means their margins must have expanded, nearly doubled, almost, from 2024, projected to be about 4% this year, 4.1% next year. But since 2021, they've been relatively stable. Now, it is a $10 billion market cap company, and they do have a decent amount of debt, about $4 billion in debt, but it's not overly levered here. And cash flow looks like it's to be improving. Earnings have been upgraded recently, and shares have been bought back from about 600 million shares outstanding down to about, looks like 380 this year. So a decent amount of share buybacks that has helped to really float this stock. Now, on a relative valuation basis, it's trading about 9.6 times forward-looking earnings, which is well below its average. And recently, they have had analysts change their estimates with those earnings up to an overweight. In the third quarter of this year, of their fiscal year 2025, because their fiscal year does end in March, they reported EPS of 0.70. They beat consensus both on the top line on revenue and on the bottom line, a 5% increase over the previous year. And so pulling back on a technical perspective, on the 1 year, it's still positive with an uptrend. It started to come down a little bit year to date, but I do worry with given the business lines that this works with, right? Industrials, consumer devices, automotive, and possible contractions within those businesses in terms of growth, with input costs being more expensive, cutting costs elsewhere. Companies that service those companies that provide that innovation, on one hand, may be ever more necessary, but may see some strenuous revenue streams as well due to the implementation of these tariffs, especially within the automotive space. And so looking at this name, if you wanted to enter a small position, I don't know if I'd even do that. From a technical basis, over the past month or so, it doesn't look great. 6 months, it doesn't look that fantastic. Although it looks pretty cheap, it's still looking to find some support that I just don't see. Especially after today, it's difficult to look at trends within the market given what kind of a weird day it was today. So for now, given the macro environment on Flex, gonna have to pass. Thanks for watching. Let's play a quick voicemail question.
Thank you guys for all the research and advice you give. Today I was looking at MYR Group. I was hoping to get your thoughts on the company. Thanks in advance. Bye.
MYR Group, that is ticker MYRG, is a specialty electrical construction services company. They have two primary segments, their transmission and distribution, as well as their commercial and industrial group. It is a $1.6 billion market cap company. They only have $121 million worth of debt. They have not issued a lot of shares. In fact, they've bought back shares over the past 5 years. But their cash flow has been trending negative since 2021, and their profit margins looks like have been slipping as well. Scroll down to these profit margins here. Well, they've been slipping a little bit, right down to 0.9% is what their margin was in 2024, though it's projected to grow back to about where it's been over the past 5 years. And sales growth looks pretty solid up until 2023 when it starts to drop off a little bit. And in fact, this year, it's still not supposed to reach back to that 2023 peak. On a relative valuation basis, it's trading underneath its 5-year average, though at this point, a lot of things are. Its price to book is 2.7 times, price to cash flow 18.9 times, price to sales 0.5 times. So it does look pretty cheap to me, but it looks cheap whilst margins were contracting, revenue was falling, not just growth slowing, but revenue falling. And the lifeblood of business, cash flow, falling as well. And so that's why I think there's a decent amount of short interest out there, even at these levels, 5.56% short interest on the back of that disappointing performance last quarter. They reported revenue of $829.8 million, a 17.4% decrease compared to the same period from 2023. They've gotten some downgrades from an analyst perspective and earnings downgrades as well. And so, when you pull back on a 6-month, on a year-to-date, on a 1 year, you see a real consistent downtrend since, sharply since December, but for quite some time. And so from a momentum basis, it doesn't look great. The fundamentals, although their balance sheet seems to be intact, doesn't look solid as well. So for now on MYRG, gonna have to pass. Cannot believe we're gonna do 4 questions, 3 questions in a row. Hit a voicemail now.
Hello, InvestTalk. Yannick from Denmark here. I have a question about Moody's Corporation, ticker symbol MCO. I'd really, really like to own this stock. I think it has a strong moat business-wise. I would like to hear what entry point you would recommend. I'd sure like to hear your opinion. Thank you a lot for a great show. Bye.
Moody's Corporation, ticker MCO, is a global, what would you call that? I guess a risk assessment firm. You probably know them for Moody's ratings, Moody's, Standard & Poor's, Fitch's ratings. They are all, say, standard bearers for risk assessment in the global marketplace. They do credit ratings, they do research, they do underwriting, they create software and tools to help with that respect. And over the past year, they're up about 10%, though they are down 7.35% year to date. They are outperforming their industry. And I have always said, not always, at a certain point, I wasn't talking about this stuff, but I have often said that one of the best ways to get invested in the financial services sector is to touch on the backbone of it. A lot of people focus on big banks. A lot of people focus on retail banks. A lot of people focus on asset managers. But I like some of the boring businesses, like the credit rating agencies, like the exchanges, which in times like these tend to do pretty well. And you did nail it in that there is a pretty big moat here in terms of the reputation and how often companies like Moody's and Standard & Poor's have been used. Now, from a balance sheet perspective, they got about $7.7 billion in debt, but there's a $71 billion market cap company that makes a lot of money and has had earnings grow pretty significantly over the past couple of years, from $7.44 in 2022 to $11.26 per share. Cash flow has improved. Their margins are, just like a lot of financial adjacent companies, pretty stellar in the 20s and 30s. Now below their pandemic high of 35.6, but still solid at 29 and supposed to grow back to 30 next year. But with this, you'll pay a premium. Forward-looking price to earnings, 27.5 times. It's below the 5-year average of 30 times, but still pretty expensive if you look at a lot of financial companies. Price to sales, 10 times. Price to cash flow, 25.4 times. I think for these types of companies, you pay a premium for a reason. Look at this relative strength compared to the S&P 500, all the way going back to 2019. I like their moat. They're an important and critical part of the infrastructure of our financial system. And so for Moody's and companies like Moody's, I think they are a good to include in your portfolio.
Elevate your investment strategy by joining the KPP Premium newsletter. Subscribe now for expert insights and tips.
Hey guys, it's James from Washington State. Noticed that Target took a nosedive. Wondering what you guys think of that as far as an entry point. Appreciate the show. Thanks. Bye.
Let's take a look at Target Corporation. Target is a large retailer. It's a merchandise store. I think we're all familiar with it. It's a little red Target is its logo as well. And I don't know if you'd call it it's definitely not the cheapest of stores, right? It's not your Dollar Generals and your Dollar Trees, but it's definitely the next step up in terms of retailers. Over the past 52 weeks, it's down 43%, down 30%-ish year to date. About 27.73, down 29.32% over the past 3 months. In terms of revenue, well, up until 2023, it was growing from about $78.1 billion in 2020 to about $109.1 billion in 2023. Then it fell off to 107, then it fell again. It's supposed to be about $107.7 billion this year. Now, in that time, cash flow has kind of trended downward, albeit not in a linear way, still trended downward. And margins have started to slip as well. Now, you got to keep in mind, retailer margins already tend to be pretty low, right? Over the past 6 years, the highest it was 6.6%. But coming out of the pandemic, a lot of people had a lot of money to spend. Now it's coming back down to earth. Closer to about 4% is where it was last year, and probably going to be about 4% this year. Forward-looking price to earnings at a 5-year low, as is its price to book value for the most part, and its price to sales. So it is definitely very, very cheap. They've had some challenges, right? They had a lot of pressure due to concerns over tariff impacts and profitability issues, right? Names like Target, who again, this is what we're talking about with retailers. They are already on very slim margins. There's a concept in economics called price elasticity of demand. And when prices go up, this number is telling you how much demand is going to fall. Some goods, it doesn't matter, right? People are always going to need water. But that's not always the case. And so if tariffs become a high input cost, there's only a certain amount you can pass on to consumers before they stop buying things entirely. And so these companies have to eat it. And so that could lead to margins slipping. That's why you saw over the past 5 days, Target be down. Well, I guess it's only down. It's still down 3.2% after the rally today. Over the past month, it's down 14% still. Year to date, it's down 28.79%. We talked about that. And so there are risks here. A lot of these goods probably come from China. Still 125% tariff there. And so even though it's really cheap, things can always get cheaper. A lot of these names like Target, gonna have to pass. Now, I got to make this one quick because we don't have a lot of time, but U.S. homeowners now hold a record $35 trillion in home equity, up nearly 80% from 2020. Despite that wealth, rising property taxes up 14% nationally are straining budgets. That's because home equity is hard to tap. Cash out refinances have collapsed due to mortgage rates sitting at about 7% now and only getting higher as spreads widen and yields on government bonds rise as well. And so we're in this phase where people are starting to feel house rich, cash poor. You can't access that. Now, one way you can access it is by selling your home, right? But capital gains taxes tend to hit you as well. And depending on what state you live in, you may be subject to property tax reassessment, right? In California, you pay taxes on the cost of your home. But on other states that don't have as high of income taxes, you may pay based on stepped up bases. And at the same time, how may tariffs affect this? Insurance rates being higher, right? If your house burns to the ground, if the cost of building homes goes up, well, then your premiums have to go up as well. HOA fees have surged. And at the same time, consumer sentiment is weakening as well. And so I always say this, housing is not an investment. There are costs to owning them. Opportunity costs of having locked out wealth. Things you don't get back. Property taxes, HOA fees, insurance premiums, which are continuing to climb. And so more so now than ever, given we are in a persistently higher inflationary environment with costs across the board rising, it is critical to consider before you lock away your wealth what the cost of that will truly be. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. Just go to investtalk.com and click the portfolio review button for this free and confidential service. We can also talk about how we can optimize the potential of your 401k and build you a full financial wealth plan. Independent thinking, shared success. This is InvestTalk. Good night.